Tonight we're hosting an event at the Whiteley Marketing Suite, where we are at the moment, for our investors. Some of our old investors who've been with us right since we started the business, and some of our new investors who are relatively new to the platform. This particular place that we're in tonight, the Whiteley Marketing Suite, is a great example of a really kind of high-end residential real estate development in London at the moment. It is actually a development that belongs to our sister company, Finchatton, and it's a lovely place for our investors to come and really understand a bit about the part of the industry that we focus in on. So we love hosting events like this. The reason for that is whilst we do operate a fully digital platform, that means our investors never have to speak to us unless they want to. We do believe very much in offering many different methods, by which they can communicate to us. So if customers want to, they can use our live chat on the website or email us, call us, but also meet us in person. And events like this we love because it gives us a chance to get to know our investors better and for them to get to know us better. So tonight is an example where we're going to be talking a bit about the prime property market, and our investors can experience that in real life by visiting this lovely place we're in. But also there'll be a panel event where I'll have an opportunity to introduce some of the members of my management team to our investors, and they can ask them questions directly about their various different departments and their perspectives on our business, the market, whatever they want to ask, they're very welcome to. And hopefully that helps sort of build that kind of open communication that we like to have with our investors, and helps build strong long-term relationships that we want to have with our customers. So we lend money to property developers, and we allow various different types of investors to invest in those loans. This just gives you a bit of an idea of some of the loans that we've done. I like the slide because it actually gives you a good variety or a good flavour of the variety of the types of projects that we fund. So we have three main geographical areas we focus on. The majority of the loan book is in prime central London. So that's Chelsea, Mayfair, Belgravia, Knightsbridge and Kensington typically. The second part of the loan book is in prime outer London. So that's where we do loans in Wimbledon, Hampstead, etc. The third part of the loan book is in the prime home counties. That's a project in Wentworth, in Surrey. And so it's really high quality residential real estate in the southeast of England. That's kind of our focus area. We have a mixture of loans in here. Mainly these ones are senior loans, with the one down here, which is a mezzanine loan. So senior loans where you have a first legal charge over the asset. Mezzanine loan where we have a second legal charge over the asset. That's obviously a higher risk, higher return type of product. And then in terms of loan types, so the majority of the loans we do are development loans. Usually about 75-80% of the book is development loans. And that can be varying from an airspace development, building penthouses on top of an existing building. It could be a complete ground-up development. It could be a refurb of an unmodernised apartment. So a real kind of range of different projects. The business has been growing very fast. To date, actually yesterday, we reached a milestone. We closed a loan which took us over the 300 million milestone. So we've now originated over £300 million worth of loans since inception. And that has enabled us, as once loans mature, to repay back 143 million to our investors in capital and returns. Let me tell you a bit about the market. So we focus, as I mentioned, a lot on prime central London. One of the reasons why that is a core part of our strategy is because we believe that it is one of the most resilient and exciting parts of the UK residential real estate market. The prime central London market is the gold line at the top. The one below that in dark blue is the overall London market, and then the kind of greyish line at the bottom is the overall UK market. We know the property market is cyclical. It's going to go up and it's going to go down. But the prime central London market does bounce back very fast. So if you look at after the 89 recession, it bounces back, it recovers back from its pre-downturn level, back to there in a much faster time frame than the overall London market and the UK market. And that happened again after the 89 recession. And the reason for that is because it is quite unique. You've got very limited stock of high quality stock that is sought after by, whether it's domestically or internationally, some of the wealthiest people around, and that provides very different dynamics. These sorts of people are much less reliant on debt to buy properties. And one other thing that's really worth mentioning is, where are we in our cycle? So we are in a completely different place in our property cycle to the rest of the market. If you have a look, this is the end of 2014. The prime central London market has been falling and it dropped about 20% since the peak. And we're now kind of in that positive part of the growth cycle. But this is kind of when we launched the business. So we've been actively lending in a quite aggressively falling market. So you have done and you will continue to read lots of things in the media about what's happening in the property market in general. I think my key message is the property market is very nuanced, and we focus on a very specialist niche within that you can't generalize and assume that what might be happening in the wider property market directly correlates with what might be happening in the prime central London property market.
Hi, I'm Stuart Peel. I'm Finance Director. So I've been with the business for about three and a half years. So obviously my role is around the strength and the financial resilience of the business. Looking after the capital structure and cash management, etc. All of our reporting internally and externally, we're obviously FCA regulated, supporting the rest of the business to enable them to do their job. So for the originators, it's kind of agreeing and signing off pricing. For the capital market guys, how are we going to fund a loan? What's our strategy around that? And obviously supporting Uma as well.
Hi, I'm Katy Catani. I'm a lending director at CapitalRise. I've been historically in the property industry for 20 years, and I joined CapitalRise just after Stuart, about 3.5 years ago as well. And my role, I sit in the lending team, and my role is primarily to source new lending opportunities that fit our lending criteria, and to make sure I cherry pick the best ones to present essentially to our investor network.
Fantastic, thank you.
Hi, I'm Mark Cecil. I've got a long career in investments generally, but more of the stocks and share type of investments. And a few years ago, I was looking for a new type of investment, and I came across CapitalRise. I actually started, my interest was as an investor in CapitalRise, and then I came to work there. And I look after the whole funding side, so bringing in investors to fund the loans that Katy brings to the table.
So what does CapitalRise look for in potential borrowers and projects?
Right, so it's important to emphasize that we have a very, very strict lending criteria and a very strict credit committee, of which Uma sits on. And we screen many deals before we even put anything through to the committee. So last year, I think we screened about 3 billion worth of new inquiries. A lot of them we rejected. The fact that we've lent just over 300 million now with no capital losses, we've returned 143 million to our investors successfully. That's a testament to how tough and robust our credit process is. So we would like to maintain that. And so what do we look for whenever I get a new inquiry? I mean, first of all, is the location. Obviously, we're very niche, so we focus primarily in prime central London space, prime outer London, as well as home counties. More and more, we're getting inquiries in the outer London locations. I think especially after COVID, there's been a lot of emphasis to single houses and more people wanting gardens. So location is key for us, as long as we're within 3 hours from London, mainly for monitoring purposes, because we have to monitor all our schemes, so we don't want to be too far. So as long as within 3 hours, these are affluent locations around London, then those are the locations we look for. Obviously, the borrower is key. Not only are we lending money, we'd like to make sure we get the money back. Our main job is to protect our investors' money, so that's very key. So we want to make sure the borrowers have skin in the game, they're experienced, they've got a good track record, they've built similar schemes of the same nature in the past. Also the professional team, so we have a list of due diligence for the contractor that's on board, as well as the professional teams. Obviously, then there's the deal itself. The leverage is very important at the moment. We'd like to keep the risk down given the current climate, so we have to maintain our lending parameters. So it's got to be within 65% loan to value if it's a development scheme. And obviously, the borrower has to have some skin in the game in terms of their own cash.
So maybe talk a bit about the independent third-party professionals that also help us with our diligence.
Again, we choose the best professionals that that we know. We have a panel of valuers, project monitors, as well as lawyers who are trusted advisors. This panel gets monitored on an annual basis, so we have to make sure we use the best people for that location and for the type of scheme that we are using. So in terms of valuers, again, we use trusted names. We're using Stratton Parker a lot at the moment, Savills, Knight Frank.
And how would you say sort of having developers on credit committee, impacts the way we look at a deal?
So I think it hugely impacts our decision-making process. So we are a lender that's founded by developers. So obviously, they've been through the whole process of borrowing themselves in the past. They're experts in the prime property market, especially prime central London. It's actually been, it's refreshing having that expertise because they know what they're doing. So it's having that knowledge.
Just to give it just a flavour of the kind of challenge that Katy and her team have to get things through credit committee. You get a valuation report from one of the kind of biggest valuers, and our credit committee think they know better than the valuation report, and they will challenge that valuation report. And you get a build cost report from, the best surveyors and project monitors, and they'll challenge the build cost because they've built 2 billion quid's worth of this stuff themselves. So. And
often it's been a deal killer.
So it also shows with how many deals we look at, how many we actually write. The kill-off rate is sort of 95% or something. So, what you look at and what actually gets past credit is a fraction.
Yes, I don't think also people appreciate the amount of work that goes behind the scenes. So from the day we get the inquiry to the day it closes, it could take 6 months. I mean, there's a lot of work that goes behind the scenes in terms of due diligence.
Great. One last question for me is on stress testing, because obviously not every project is going to go to plan. How do we look at that?
So again, we have a full team of analysts back in the office. So again, we do a lot of stress testing. Financial analysis. Also, we're very big on comparables. So again, we don't just rely on the valuation reports. We have to call all the local agents ourselves and kind of get our own opinion as to where we think the value sit. So again, it's a lot of work.
Okay. I might come back to Katy then. How do we monitor our loans? So, okay, we've made the loan, the money's gone out the door, then what happens?
Right, well, our job doesn't end there. So if it's a construction loan, then obviously we have to monitor the scheme throughout the life cycle of the project. So the day the loan closes, it doesn't mean our job is done because we have to monitor the scheme until it redeems. So I myself, along with the project monitor, so before anything else, we appoint a trusted project monitor for the scheme, depending again on size and location. And someone from CapitalRise, so that's either myself or someone from the team, will always make sure that they're on site once a month, along with the project monitor, to make sure that the project is going according to plan and to budget. We also have monthly meetings along with the portfolio management team, monitoring, going through all the deals one by one. And we provide quarterly reports also to our investor network. So
nice and easy.
It's quite a rigorous
yes, I think
process.
For me, when we had sort of all of the impact of COVID, that was a real test to the business. Instead of doing monthly monitoring, we're doing weekly monitoring. And there's a lot of disruption in the market. It was a very, very difficult time for developers. But I think the fact that we kind of lived through that and managed to work collaboratively with all of our developers to find a way forward. So for many of them, plan A was not going to get us out on time, so we had to put in a plan B or a plan C. And I think having that close working relationship with our borrowers and being very, very diligent and all over those loans is the only way you can, I think, kind of have the sort of track record that we've had.
Yeah, it's also important to emphasise that not many lenders actually go on the monthly site visits, so they just let the project monitor kind of get on with it. But we're one of the few lenders that takes an interest and goes on site once a month. And I think a lot of our borrowers appreciate that.
Okay, this one's for you, Stuart. So this is about rising interest rate environment we've been in, a crazy year that we've lived through. How have we kind of adapted our business, our product, the way we think?
Yeah, so when you saw from the graph earlier that since CapitalRise was founded, we've obviously lived through Brexit, COVID, some challenging some challenges there, but it's been it's been a completely stable interest rate environment until about the last 18 months, as you know. So during that time, we've spent more time looking at pricing in the last year than probably in the previous 5-6 years of the business, and constantly have the SONIA curve, 2-year bond yields, and all of that open on the screen to make sure that we're adapting and adjusting. So on the lending side, the lending market has not actually moved. Interest rates have gone up approximately 5%. The lending market hasn't moved as much as that. So we've moved our pricing as far as we can to make sure that we're competitive in the market, still able to do the types of loans and the volumes of loans that we want to.
Give us on to Cathy to start off with. So is there still high demand for prime property finance in the current economic climate?
Yes, so it's been a challenging year, I think, in general, but we're actually busier than ever. So I would say the prime end of the market is definitely the most resilient. It has stayed resilient for many years, and there's definitely a lot of demand, especially from overseas. We're seeing a lot of overseas buyers, especially from the US, China, Middle East, coming into the UK, especially because of the exchange rate for them. It's pretty much UK on sale, especially prime central London on sale in some cases. So we're seeing an influx of interest for some of our assets that are nearing completion. To give you an example, we have a project on the Wentworth estate, which has just started being marketed by an agent, and they've already got 2 offers, potential offers, nothing's exchanged, but they have 2 offers for 17 million already, one from China and one from the US. And also because these are trophy assets, so they're one-offs, and there's definitely a lot of demand for these type of assets in the market. And to give you an idea of in terms of our pipeline, we've got the strongest pipeline at the moment than we've had the whole year. It has been a tough year. But as it stands, we're in our first quarter of our new financial year, so potentially we could have about 85 million worth of loans closed, which will be our strongest quarter yet. And we're extremely busy. We're getting at least 4 or 5 inquiries a day, and these are all prime central London, prime outer London inquiries.
The economic environment has actually enabled us to target higher quality borrowers, because there's a lot of other lenders who have withdrawn from the market. So people who previously may have been getting finance from a bigger, better known institution coming to us, and we're building really good relationships with them. And with several of those, we're now into our second, third loan with them already. So the quality of the borrowers that we're able to lend with has definitely increased as well.
Okay, I think this might be the last question. What is the future for CapitalRise? Well, the future should be bright. So I think for us, we feel there's a huge opportunity for us, particularly right now. In times like this, sort of slightly uncertain times, what typically tends to happen is traditional lenders tend to sit on their hands or pause or retrench on their lending appetite. So it provides a huge opportunity for alternative lenders like ourselves to go in and kind of capitalise on that potential business. And we've built a fantastic team. We did quite a lot of recruitment in the last sort of 12 to 18 months. I think the team we've got now definitely has the capacity to do, double, triple the kind of volumes that we're doing at the moment. Got some more new hires on their way, so we'll continue to augment the team with new talent in various different areas of the businesses as required as the business continues to scale. But I think, in terms of the demand from investors and how quickly our loans fund, in terms of the volume we're seeing from deals, the strength of our pipeline, we're very, very optimistic. And obviously the state of the market, the fact that we're operating in a very, very active, very resilient part of the market.